Good evening, guys. A very warm good evening to everyone. So let's wait so that others can join as well. We'll start in next couple of minutes. So guys, shall we start? Guys, shall we start? So Soumya, if you're stuck in internship after submitting the file, you will read, you will get a solution sheet and you can refer that. Okay. So let's start. Let's continue our discussion on derivatives. We saw forward contracts in derivatives, we saw future contracts in derivatives, and finally we saw options. I guess some of you are comfortable with options, some of you still have some doubts. So to gauge the experience that what is our level of preparation with options, let's try to solve few more example with the options. Okay, is it good if we start with examples? If we start with options, perfect. So yeah, we will be also revising it through the examples. Try practicing examples and that would help you for the revision purpose. It's not possible technically to use Hindi words because we have our international students on board with us. So that is why we can't use Hindi. I'm really sorry, Naveen, about it. But even I wish to, I would be able to speak Hindi because we are not allowed to do so. Okay. But still, if you, from my end, if I could be of any help, if you want me anything to repeat, I would be happy to repeat it. In case you are not getting anything, make sure you raise a ticket about it and we can connect for a one-to-one session. Yeah, finally, when we will be done with swaps as well, I will give the overview of derivatives. Don't worry. Let us first complete with again, I'm really sorry. We are not allowed to share personal contacts as well. You will have to raise a ticket and through ticket portal, we can connect. Okay. But still, if you wish that you need any of those requirements, uh, you can just raise a ticket about it and the management will see, look after the issue and based on that, they can take a call. So you might have received a PW. If not, raise a ticket about it. Any other issues regarding the core curriculum, please raise a ticket about it. I won't be the best person to help on those matters. Okay. So PW is saying I'm in the last month of my course and didn't got the internship yet. I am suggesting him and everyone else to raise a ticket about it So let's not waste the time of the class. Let's start with our session. So strike price is 750. Market price after 6 months is 900. Call premium is 90 rupees. Put premium is 100 rupees. Find profit or loss for call seller or call writer. Seller, writer is another word for seller. Call seller or call writer. And find profit or loss for put buyer. Okay. So strike price is 750, market price is 900, call premium 90, put premium 100, profit or loss for call seller and put buyer. This is what you need to find. Waiting for your answers, guys. Okay, GV is saying call seller has a profit of 90 rupees. Okay. GA is saying on the other hand, loss for call seller is 60, loss for put buyer is 100. Let's see. Call seller profit is rupees 60. Okay. Three answers, three different responses. Let's check who is right. While meanwhile others are solving as well. Call seller loss of 60 rupees is said by NB. 50 profit for put buyer is what PM is saying. MK is saying call seller 60 rupees profit. RN is saying call buyer profit 60 rupees. PK is saying profit of 150 rupees. Guys, do you need more time or shall I start with the explanation part? How many of you need more time? Ask me to wait, please. Mention wait in the chat box if you need more time. Okay, DA wants me to wait. TH is there with an answer. PJ is there with an answer. DK is there with an answer. So yeah, Wasim, we have not started with anything yet. The question is right in front of you. Try solving for the question. We are just revising what was covered in the last part of the yesterday's class. And based on that, we are moving forward. So try solving the question that is present to you in the whiteboard, Wasim. KV is there with an answer. Profit for put buyer is 50 rupees. Let's see. Let's see. Even I don't know the answer yet. Even I don't know the answer yet. So when I'll explain, just make sure you cross check with your answers that you submitted. Okay. So DA, you asked me to wait. Shall I start with the explanation part? Perfect. Everyone, anyone, do you are, yes, I am explaining. Anyone still practicing? Anyone still trying it out? Because it would be better that you're not getting, I'm there for you. What is selling SP and MP? Where is SP? Where in the blackboard can you see SP or MP? Okay, strike X is the strike price. I told you yesterday, right? Strike price is X, market price is this one. I told you yesterday strike price is denoted by X. Yes, KS. So KS, just cross check with the solution whether you are right or wrong. Okay. Let me solve here itself. First, let's say the nature of the contract is a call option. We will always evaluate from a buyer's point of view or seller's point of view. We will always evaluate from a buyer's point of view. Correct. Let's say I am a call buyer where the strike price is 750 and market price is 900. So something is worth 900 that is available to me at 750. I am definitely going to buy it. It means that I am exercising the option. When I am buying at 750 and selling at, now, do you want me to write that if as a call buyer, I have a right to buy? If you don't remember, although after a while you will feel the no need to write this. But if you still don't remember, make sure you write this. As a call buyer, you have a right to buy. I have a right to buy something at 750 that is worth 900. So I'm definitely going to buy it. My gross profit over here is 150 rupees. But to earn this gross profit, I have paid some amount to the as a call premium. So what was the call premium? 90 rupees. So effectively, I earned 60 rupees profit. Since I earned 60 rupees profit to the buyer is loss for the seller. Seller has a loss of 60 rupees. How many of you were correct with this part? How many of you were correct with this part? And how many of you got it right? Okay. Okay, perfect. Perfect. RN says he is correct. DA, SC, KV, GA, PJ, AR, PM, KG, KV, GA. Everyone says that they are right except GV. But GV, are you? Okay, premium. Tell about premium. I'll come to the premium part. Yes, I am a call seller. That is why yesterday, if you remember KS, I told that we will always evaluate from a buyer's perspective. Profit put to the buyer is the loss to the seller, and loss to the buyer is the profit to the seller. If you remember here, although we are a call seller, we are evaluating profit from a buyer's perspective. Buyer made a 60 rupees profit. That is why seller made a 60 rupees loss. That is what we concluded. Why? Because option is a zero sum game. If you remember, I told this yesterday. Option is a zero sum game. Now, what is premium? Premium is the amount that you paid to buy these options. As a buyer, you had bought the options and you have paid the premium to the seller. Are you getting this, Shivani? Premium is the amount that buyer of the option pays to the seller. So that is why, although buyer won 150 rupees, although buyer got 150 rupees, he had spent 90 rupees. So 90 rupees will be deducted from this, and profit to the buyer is 60 rupees. Profit to the buyer is again the loss for the seller. That is why loss is reported as 60 rupees. Everyone clear with this part? Everyone clear with this part? the first question. Everyone, shall I move on to the second part? Please let me know here itself. Otherwise, if I will rub it, it won't be possible to me to explain it again. Okay, shall I move ahead? Perfect. Let me rub this. Next, we are evaluating a put option. And again, we will always see from a buyer's point of view. Correct? What does put buyer has? Put buyer has a, what does put buyer has? Put buyer has a right to sell. Put buyer has a right to sell. Put seller has an obligation to buy. So don't get confused in this. Call buyer has a right to buy. That is why call seller has an obligation to sell. Since put buyer has a right to sell, put seller will has an obligation to buy. Right to sell what? Right to sell underlying asset. So PM, call buyer has an right to buy the underlying asset. Put buyer has a right to sell the underlying asset. That underlying asset can be anything. It can be gold, silver, commodities, wheat, iron, cotton, Reliance shares, Tata Motors shares, any other shares. It could be bonds or anything. Anything. So that is right to buy and right to sell for you. What right to buy and right to sell? What? Underlying asset. Why? Because derivatives is something that derives its value from an underlying asset. Put buyer has an right to sell. Put seller has an obligation to buy. Okay. Don't get confused. This is the basic understanding. Yes, it was about buying and selling the same, not about same asset. We have not considered any underlying asset, but the mechanism will work in the same way for every asset class in the world. The mechanism will work in the same way for every asset class in the world. Evaluate from a buyer's point of view. What does put buyer has? Put buyer has a right to sell. I remember I told you tomorrow, some people are getting confused between call buyer and call put buyers, call sellers and put sellers. Always remember, in options, you have two options, call and put. Either you can buy a call option, either you can sell a call option. When you buy a call option, you get a right to buy. Right to buy what? Underlying asset. When you sell a call option, you get a right to sell. Right to sell what? Underlying asset. Put buyer on the other hand, right to sell. Put buyer has a right to sell and put, oh, sorry. Obligation to buy, obligation to sell. Call seller, call seller has an, very good guys. Seller always has an obligation in case of options. Obligations, if he is buying, he must be selling to obligation to sell. Put buyer, right to sell. That is why put seller, obligation to buy. And this is what we saw. If you don't have this written anywhere in your notebook, you might be confused. Please write this note anywhere. Please write this note anywhere inside the notebook, and this would help you refer the problems. This will help you to refer the notes while solving the problems. Okay. Fine. Put buyer has a right to sell. Current strike price is 750. Current market price is 900. As a buyer of the options, whether I will sell at 900 or 750. If I am a seller of the underlying asset, if I want to sell something, whether I would sell it at 900 or 750, I would sell it for 900 and let this option lapse. I will let this option lapse. And since as a buyer, I have paid 100 rupees to get these options, 100 rupees is my loss. So as a put buyer, I am having a loss of 100 rupees. If I might have asked from a put seller point of view, if we might have got this from a put seller point of view, we would have got 100 rupees profit. A call option where buyer has the right to buy, correct. Put option where the seller has a right to sell. Cross option, the buyer receives a call option seller in return and gains a put option that is not included in the syllabus yet. Option agreement, the complete guys. Okay, so you have shared a article with us, DA. That is really great. Yes, I am giving you another problem. Just wait for a second. Was, sir, was is this specific standard term for the option? You had said something yesterday. What I mean, what was the specific standard term for options? You had said something yesterday. It was contingent claim. Contingent claim. What will be the value of the option will be dependent on a future event, how the price of the underlying moves. Why put buyer is at a loss? I will tell you, PJ, why put buyer is at a loss. Yes, Ravi, you are correct. If buyer is in a profit, seller will be in a loss. If seller will be in a profit, buyer will buy notes able to clear. Missed some class will buy notes. Yes, if you have missed those classes, I think notes would be sufficient. But if you are not able to understand through notes, if you are not able to understand through notes, go through the recorded sessions. Investment bankers do trading in derivatives. They do not actually trade in derivatives, but derivative is a financial instrument which is used in many investment deals. Okay, so as an investment banker, you need to have a sound knowledge of derivatives, or even if you are interested to go towards a trading desk, which is a part of an investment bank, whether you are associated in buying and selling options contract or future contract or forward contract, you need to have a good knowledge about the characteristics of derivatives. But more or less, we are into fundamental. The course is focused related to fundamental analysis and not technical analysis. Coming back to why there is a loss for put buyer. Being a put buyer, what do you get, PJ? Being a put buyer, what do you get? When you buy a put, you get a right to sell. And if you have a right to sell, whether you will be selling it at 900 rupees or 750 rupees. If you have a right to sell, whether you will be selling it at 900 rupees or 750 rupees. So that means you chose not to sell it for 900 rupees. You chose to sell it for, just give me a second, guys. I don't know why my pen is not functioning. Okay. No, if you are making profit in the call option, you will be making loss in the put option being on the buyer side. If you have taken both call and put, you will be making either profit or loss. If you are buying call and selling put, then there is a chance that you can make profits. Okay, Ravi. So you need to take opposite position in call and put. Now the question is, okay. Now the question is, why the loss for 100 rupees? Why the loss for 100 rupees? So being a buyer of the put option, you have a right to sell. Everyone told that you will be selling in the market. And if you will be selling in the market, you are letting go the option contract. And if you are letting go the option contract, you paid 100 rupees for buying this option contract because the put premium was 100 rupees. Are you getting this? Whoever asked the question about PJ, PJ, did you got this? And since you had paid 100 rupees and you didn't get anything out of it, that is why 100 rupees is a loss for you. Okay. Loss for a put buyer is a profit for the put seller. Okay. Put premium means the amount paid by the put buyer to put seller. The amount paid by put buyer to put seller is the premium. The terminology is premium for that. Okay. Shall we start with the next example? Strike price 360. Spot price at maturity 420. Call premium 90 rupees. Put premium 160 rupees. Let's say this is 190 and 160. Evaluate from call, seller, and put seller point of view. 420 is spot price at maturity. That is current market price at maturity. Current market price after 3 months of contract when the contract gets expired. Okay. Strike price is the price at which the buyer gets the right to buy or sell the underlying asset. It is in per unit terms, not in lot terms. It is in per unit terms. RT. Call seller 130. Okay. Call seller is at a 130 rupees profit. Put seller is at 160 rupees profit. Both are making profits. Why? Because market went sideways. From here, what we meant is when market will consolidate, then so this example is given to you to let you know that option buyer option buyer loves volatility. Option seller hates volatility. Why here both the call sellers and put seller won is because market was range bound. Market was in a range from 360 to 420. Volatility means the shift in prices of a asset. The shift in prices of the asset or the movement in prices of the asset is volatility. So if what seems to be more volatile? This seems to be more volatile. So just a second, let me draw this. This seems to be more volatile, or this seems to be more volatile. This is A, this is B. What seems to be more volatile? A, right? Volatility is nothing but price movement of an asset. If the asset are rising and falling, have rising and falling prices very fast, it is called a volatile asset. Volatile asset means the price of the asset is moving up and down very quickly. On the other hand, if there is an asset which is range bound, it is said to be in consolidation. This is a flat price. This kind of a diagram where the prices have been range bound and not showing a continuous or a sudden peak or a sudden fall is called a less volatile asset. Okay. Now, everyone was comfortable with the answers of these two. Everyone was comfortable. Yes, when the VIX is high. So how does volatility is measured? There is volatility index of every nation. Yes, I will explain that answer as well. Don't worry. So volatility index, if you want to measure volatility of India, there is India VIX through you can measure the volatility. Okay. Now, some of you are still confused in this. Let me explain this to them. Let me explain this to them. Let's evaluate from a call option point of view. As a call buyer, you will have a right to buy. Correct? A, correct? As a call buyer, you have a right to buy. And you have two options: to buy in the contract at 360 rupees and buy from the market at 420 rupees. So you bought from the contract at 360 rupees and sold in the market for 420 rupees. The profit that you made is 60 rupees. The profit that you made is 60 rupees. But you paid 190 rupees to buy that contract. So effectively, 60 rupees profit, 190 rupees loss, 130 rupees is the loss that you suffered. Now, loss for the buyer is profit for the seller. That is why call seller made a profit of 130 rupees. Are you clear with this, KA? Are you clear with this, K? But profit for the seller is 190 rupees. No. Why? Because although the seller received this 190 rupees, Priyanka, how can he not execute the order? He definitely will have to square off the order, right? So if at 360 rupees, this guy, that is the buyer of the contract, exercise the call option, it means that he bought it from 360. Please try to understand, Priyanka. Yes, you are correct. How? If he square off in the market, he will have to buy it at 420 rupees, but he is buying at 360 rupees. To give the buyer at 360 rupees, the seller will have to buy from the market at 420 rupees, right? Seller will have to buy from the market at 420 rupees and give it to the buyer at 360 rupees. Are you getting this? So here 60 rupees is the loss for the seller, but he gained 190. So that is effective profit is 130 rupees. I told you always, that is why it would be confusing. That is why I told you always look into this from a buyer point of view, from an option buyer point of view. It would be easy for you to remember the flow, and the profit for buyer would be the loss for the seller and loss for the buyer would be the profit for the seller, since option is a zero sum game. Clear? Are you clear with this, Priyanka? Call premium will be given by the buyer to seller. Call premium is always given by the buyer to seller, whether it is a call option or a put option. Okay. Just give me a second, guys. Yes, it is always, if they both are in the call option or if they both are in the put option, option is a zero sum game. Profit for the buyer will be the loss for the seller. Okay, perfect. Khushbu, do you want me to evaluate from the seller put seller point of view as well? Or are you clear with this? Okay, please let me know if you want me to evaluate from the put option point of view, or are you clear with this? Okay, put, we are evaluating put buyer. We want seller, but we are evaluating put option. And as a put buyer, you have a right to sell. As a put buyer, you have a right to sell. Everyone, KV, NB, and KA. Are you guys clear with this? Even RK. RK, KA, KV, and NB. Are you clear with this? Put buyer has a right to sell. Where will he sell? In the market or in the contract? In the market or in the contract? At 420 or at 360? If you want, if someone asks you to sell, whether you will sell at 420 or 360? At 420, right? 420 is market price. 420 is market price. It means that you will let the contract lapse. You will let the contract lapse. You will make no use of the contract because something is worth 420 and someone is paying you 360 for it. You won't want to sell it for 360. You will let that contract lapse. So 420 would be the market price. Now, since you paid 160 rupees premium for that contract, 160 rupees is the loss for you as the buyer of the contract, and loss for the buyer is nothing but profit for the seller. Loss for the buyer is profit for the seller. Comfortable? That is why seller is making, put seller is making 160 rupees profit. Everyone comfortable with this? Fine. Soumya, whether you will be selling at 420 or 360. But anyhow, if the market price is 320, market price is not 320, market price is 420. Can you see it over here? Market price is 420. If you are selling it for 420, you are letting go this contract. You are not exercising this right to sell at 360. So you are letting go this contract, but you bought this contract for 160 rupees, and that 160 rupees is net loss for you. You didn't gain anything out of it. 160 rupees is the premium. Premium is given to you. Now we will come how, based on what these premiums are calculated. But for this question, premium is already given to you. So don't worry about it. How these premiums are calculated, that is something we are going to cover now in the next part. No, contingent. In case of options, options are exchange traded and no one can breach the contract. Again, like futures, there is deposit of margins. That is why no one can breach the contract. And basically, seller is the one who breaches the contract, who could have breached the contract, but seller deposits the margin over here. That is why uh, the counterparty default risk is something that is not available with the options contract. Okay. Shall we move ahead, everyone? Other is said that sir 360 put buyer sell or it to 420. So put buyer sell, put buyer that has a right to sell will sell it at 420. And if he sells it at 420, he has not made any use of this contract. He has not made any use of this contract. So 160 rupees that was paid to by the buyer to the seller is the net loss for the buyer. Are you getting it, Wasim? This is the net loss for the buyer that buyer paid to the seller. He had not made any use of the contract and that is why it is a loss. Perfect. Let's move ahead. I will give you now, please try to implement all the knowledge that we had discussed as of now. And based on that, please try to answer this. Premium is, premium is, sorry, strike price is 1000. Current market price is 1100. Strike price is 1000. Current market price is 1100. I am talking about the call option over here. I am talking about the call option over here. Can you determine what could be the call premium? Can you determine what could be the call premium? Priyanka is saying more than 100. Very good. Very good, Priyanka. Why more than 100? 100, more than 100. Why more than 100? Very good, Priyanka. Really glad from your response. No. Yes, option has time value. Okay, very good. Very good. How to evaluate? Okay, those who are not getting how to evaluate, don't worry. We are coming to that part. We are coming to that part. We have not discussed that part again. But the content that we had covered as of now was sufficient enough to know, with a little bit of, with the application of little bit of common sense, it was sufficient enough to know that the price would be more than 100. I will tell you why. I will tell you why. 100 rupees. Let's not talk about 100. Let's not jump to 100. something is worth 1100, and 3 months from now, let's say the contract is expiring 3 months from now, and you want me to sell it at 1000. What is the premium? Premium is what buyer, call buyer over here, pays to call seller. What does call buyer pays to call seller? Premium. What does call seller pay in return? What does call seller pay give him in return? Call seller give him right to buy. So he gets the premium. He gets right to buy. And with this, he has obligation to sell. And to take this obligation and give a right, seller is everyone clear till here? Everyone clear till here? KV, are you clear? Everyone? Perfect. Now the question is, something is worth 1100 today. 1100 today. And you want to buy it from me after 3 months piece. You want to buy it from me after 3 months at 1000 rupees. So I am assuming the risk. I am assuming the risk of it going up in these 3 months, and I am promising you at 1000. What I would expect you from is the difference between the price and between the strike price. At least, again, I am saying the word, at least I will receive 100 rupees from you. I will expect 100 rupees from you, that if you want this at 1000 from 3 months from now, pay me 100 now itself. Although I am going to ask you more than 100, although I am going to ask you more than 100, but at least I would want you to pay 100 rupees, because you want this 3 months from now at 1000 rupees, and currently the price is 1100. Everyone clear with this? Where this 100 plus is coming from? Everyone clear with this? No worries, SK. Let me. Let's say Soumya and I enter into a contract. Let's say Soumya and Shivani enter into a contract. Let's say Soumya and Shivani enter into a contract. Soumya is a call writer. Shivani is a call buyer. And they are, Shivani has bought call options of, Shivani is buying call options of Reliance Industries. Shivani is buying call options of Reliance Industry. So Soumya will be selling call options of, if Shivani is buying, Soumya will be selling call option for which company? Which company, Soumya? Obviously Reliance. Just give me a second. What is happening? Okay. Shivani is call buyer, Soumya is a call seller. Shivani will, and the maturity of the contract is after 6 months. The maturity of the contract is after 6 months. Since Shivani is buying the call, she has a right to buy. And Soumya is selling the call. He has an obligation to sell. There with me, everyone. Till here, everyone there with me. Now, who is sacrificing over here? If we exclude the for a moment, if we ignore the premium part, who is sacrificing over the here? Over here, Soumya is sacrificing as a call writer because he is having right to buy. Either he can buy or either he won't buy. Sorry, I am talking about Shivani. Either she can buy, either she won't buy. She has a right to buy. She has a choice. It's completely in her hands. But if she wants to sell it, so Soumya is sacrificing over here. Correct, Shivani? Shivani, are you there with me? Shivani, are you there with me till here? Perfect. Now, the current market price when the contract is going to sign, that is S0. S0 is 1000 rupees. Let's say S0 is 1100 rupees. S0 is 1100 rupees. It means that currently, if you want to buy Reliance shares, you will have to buy it at 1100 rupees from the market. Spot price after 6 months, sorry, not spot price after 6 months, but exercise price or strike price. Strike price is 1000 rupees. It means that it has been explicitly mentioned in the contract that if Shivani wants, Soumya will need to sell these shares to Shivani at 1000 rupees. If Shivani wants, Soumya will have to sell these shares to Shivani at 1000 rupees after 6 months. After 6 months. Now the question is, what Soumya will charge to give Shivani this right to buy? The question is, what is Soumya going to charge to give Shivani this right to buy? The idea is clear, Shivani? Till here? Till here, is the idea clear, both Soumya and Shivani? Okay. Now, something is worth 1100 and Soumya, something is worth 1100 and the buyer wants it at 1000. Something is worth 1100 and buyer wants it at 1000. Something is worth 1100 and buyer wants it at 1000. So Soumya will say, it is already of 1100 and you want me at 1000. You need to pay me at least 100 rupees now so that I can sell this to you at 1000 6 months from now. At least pay me 100 rupees now so that I can sell this to you after 6 months at 1000. Does this make sense, both Soumya and Shivani? Do seller has option to ask yes? So it's not the negotiable contract. I'm giving you the logic behind how it is actually priced. This is not a negotiable contract. This is priced. This is actually priced. But what is the logic through which it is priced? That is what I'm trying to give to you, Shivani. This is not a negotiable contract. I am just trying to give you a perspective that based on what the premium is decided. It should be a fair game to both you and Soumya, right? It should be a fair game to you and Soumya, both buyer and seller. So how the price is determined that it is fair for both of them, that is what I am trying to give you. Premium is not set by seller. Premium is not set by the buyer. Premium is priced using a formula. And that is a model, option pricing model, binomial option pricing model, or Black and Scholes model. There are various models of pricing a premium of option, but we don't need to get into that. We don't need to get into that. There are computer applications made. You just need to add the contract value and terms and conditions. It will throw you out the premium. So we don't need to get into the calculations of all those things. Yes, that is quantitative finance deals with all those things. We are not here. That is something related to data science and data statistics. Okay. You will need to learn some Python programming languages to learn all those things. So we don't need to get into that. We are only trying to understand that what is the logic that has been fed to that algorithm based on which the premium is decided. Are you getting this, everyone? Everyone? Everyone with me? Perfect. So Shivani, you will say, not Shivani, but Soumya will say that at least pay me 100 rupees now so that 6 months from now, I am going to sell you at 1000 rupees. Okay, perfect. Comfortable till here? Soumya agreed. Soumya agreed. Soumya agreed to pay 100 rupees and was going away after signing the contract. But sorry, Shivani agreed for paying that 100 rupees now and going away while signing the contract, moving ahead with signing the contract. But Soumya said, wait, Shivani. What Soumya said? Wait, Shivani. Soumya asked Shivani to wait. What I said is, I want at least 100 rupees, not only 100 rupees. For this 6 months, I am assuming the risk. I am assuming the risk of price moving up. So let's say what can happen after 6 months? What can happen after 6 months? Two things can happen. Either the price can go to more than 1100, that is 1200, or either price can go to 900. These two things can happen. If price goes to 1200 after 6 months, if market price goes to 1200, yeah, it can be 1000 also. But let's assume, for now, let's assume that it is at 1200 or 900. It can be even 1100. But since we are assuming two prices, let's say either the prices will go up or go down. Let's say the market, it could also be 1000. Let's substitute this 900 with 1000. Happy? Now let's evaluate what will happen. If the price is at 1200, Shivani is going to exercise this option and buy it at 1000, gaining 200, and paid 100 rupees for premium, making 100 rupees profit. Correct? If price went to 1000 or 900, Shivani is directly going to buy it from the market. No, I'm not sorry. Actually, adding this 1000 over here will just create a confusion that whether this 1000 is a strike price or market price after the market after 6 months. So that is why I took 900 over here. I'm sorry if I offended you, but just for the sake to avoid confusion, I took 900 over there. So if the prices are 1200, see what will happen. If the prices are 1200, will Shivani exercise the option or not? Is Shivani going to exercise the option or not? So if something is worth 1200 and you are getting it at 1100, Shivani, will you be buying it? Yes, you will be buying it. But if it is at 900, will you be buying it? So there is a gain for Shivani. No. So this was from the Shivani point of view. If the price is 1200, will Soumya will have to sell it? If the price is 1200, will Soumya has to sell it? Yes. And if the price is 900, that is if the price has fallen down, can Soumya sell it to anyone else? Can Soumya force Shivani to buy it? If the price is 900, can Soumya force Shivani to buy it? No. So who is assuming the price risk? Who is assuming the price risk? Soumya is assuming the price risk, means seller is assuming the price risk. Shivani, are you getting this? Seller is assuming the price risk. And if seller is assuming the price risk, don't you think he should be rewarded for it? Don't you think he should be rewarded for it? So the premium would be at least 100 rupees plus the amount of taking the risk plus assuming the risk. Now, the question is the 100 rupees that is minimum amount that Soumya is expecting is called intrinsic value. And the amount Soumya is assuming risk. That is why it is paid to him for 6 months. Soumya is assuming the price risk for 6 months, and that is why it is paid to him. It is called time value. So, option price or option premium is classified into two types, not classified, but can be broken down into two types: time value plus intrinsic value. Time value plus intrinsic value. So what is the formula for option premium? Time value plus intrinsic value. Okay, everyone comfortable? Option premium is equals to time value plus intrinsic value. For volatility, there are different terms like geeks, that is gamma, theta, delta. All those things are related to trading, guys. Priyanka, option definitely if volatility is higher, the premium would be higher, the premium would be inflated. But that is again related to trading of options. We are doing expiry day analysis. We are going to hold the option for maturity. Why? Intrinsic value is the minimum amount that we discussed over here that Soumya demanded. Okay. We are doing expiry of maturity, expiry day analysis. Why? Because we are not using option for speculative purposes. We are not using option for speculative purposes. We are evaluating option for hedging purpose. We are evaluating option for hedging purpose. And that is why we don't care between the two periods whether the price is high or low. Ultimately, it will converge to this. And that is why we don't need to get into geeks, option geeks. Okay, we will be ignoring option geeks and trying to do expiry day analysis. Perfect. Now, if think about it, if strike price is 1000 and current market price is 1300, what is the intrinsic value for a call option? If strike price is 1000 and current market price is 1300, what is the intrinsic value of the call option? Intrinsic value I am talking about. Intrinsic value. We don't know time value. Time value is something else. Okay. But the minimum amount is 300 plus there would be time value. So the option premium would be 300 plus. Correct. Option premium would be 300 plus. Similarly, taking second example, let's say intrinsic value is 1500 and time value is 1900. What is intrinsic value? Sorry, strike price is 1500 and current market price is 1900. What is the intrinsic value? Strike price 1500, current market price 1900. What is the intrinsic value? 400. Shivani, are you understanding this? Subrata, are you understanding this? SK and even Soumya, understanding this? Now tell me, three of you guys will tell me, and with them everyone else, tell me that if strike price is 800 and current market price is 1200, what is the intrinsic value? What is the intrinsic value? Very good, Wasim. Very good, Wasim. Very good. Wasim is the only one who said that intrinsic value will be zero. Wasim is the only one who said that intrinsic value will be zero. Let's clear all this and let's revise it. I think there was some confusion. Earlier, it was interest strike price and current market price was introduced. Just give me a second. Current market price, strike price 500. Yes, I agree. I agree, GV. Just hold on for a second. Strike price 500, current market price 700. Intrinsic value 200. Example 2. Strike price 900, current market price 700. This time intrinsic value, strike price is the price at which you agree to buy or sell in future. Yes, correct. Strike price 900, current market price 700. This was the same example that I gave last time. I told something like this, if you remember, right? Did I made any mistake last time? Last time, what was the strike price did I took? I guess 1500 and current market price 1900. Did I took that? Was this the example that I take? Sorry, that was my bad. That was my bad. I wish to take it 1200. Okay, so that was my bad. So Wasim, I'm sorry, you were wrong. Everyone else were right. Now, so you were clear till here. You answered it correctly that intrinsic value will be 200 over here. What is the intrinsic value in this case? What is the intrinsic value in this case? Every one of you are saying zero. Why? Why zero? In case in case of a call option, intrinsic value is zero. What in case of a put option? What is the intrinsic value in case of a put option? Very good. No, it won't be same, PJ. It won't be same. I'll tell you why. Okay. How many of you didn't got this? Those who have got this, let me give them a shout out. Those who said zero, Priyanka, GA, Soumya, VT, SC, SK, Shivani, NA, all these guys, Wasim, Vijay, everyone told that it would be zero for call option and 200 for put option. Now, those who have not got this, please let me know. Please comment, I didn't got. Options do not have zero value to begin with. Forward and futures have zero value to begin with, GA. Options have, okay, PJ and SG. Are there only two people who didn't got this? Or are there anyone else? PJ and SG, are there only two people who didn't got this? Okay, let's start. Yes, KV, you are correct. Now PJ and SG, please be attentive and please reply me. Please reply me when I am asking. Option premium is, what is the formula for option premium that we just discussed? What is the formula for option premium that we just discussed? Correct. Time value plus intrinsic value. And we are evaluating intrinsic value over here. Correct. Let's talk about the call option. Always things from a buyer perspective. Strike prices, that is, you have a right to buy at 900. Current market price is current market price is 700. It means that if you buy in the contract, it is worth 900, and if you buy from the market, it is worth 700. Is the contract has any value to you? Does this contract has any value to you? PJ and SG. Something you want to buy PJ, think about this. Please think with a complete 100% common sense that if you would want to buy something, whether you would buy it at 900 or 700, whether you would buy it at 900 or 700, you would buy it at 700. Why do you use forward option contract to buy it at a lower price, but the strike price over here is 900? Now, does this contract holds any value to you? Is it of any value to you? Does this give you any advantage? But does this give you any advantage, PJ? This does not give you any advantage. SG, does this give you any advantage? Market price is 700 and someone is selling you at 900. Don't you think he is fooling you? Will you enter into this contract? Maybe no. And while hedging purposes, definitely no. So this is not adding any value to you. That is why it has intrinsic value 0. That is why it has intrinsic value 0. On the other hand, if current market price would have been 900 and strike price would have been 700, something is worth 900 and be sold at 700. In that case, you could have said that 200 is the intrinsic value, because something is worth 700, something is worth 700 and you are pricing it at something is worth 900 and you are getting it at 700. Then it adds value to your life. Are you getting this, PJ and SG? Something is worth 900 and you are getting it at 700. That means it is adding value to your life. So it has an intrinsic value, but something is worth something is worth 700 and you are being getting sold it at 900, it is not adding any value to your life. So that is why it has an intrinsic value of 0. Clear with this, SG? SG, are you clear with this? Let me know so that I can jump on to put options. I will take the same example and explain you put options. SG, shall I move forward? Perfect. We will always look from a buyer's perspective or seller perspective. So this, yeah, this current market price, I am talking about current market price while signing the contract. PJ, this current market price, I am not talking about current market price at maturity. I am talking current market price while signing that contract. T equals to 0. Time equals to 0 when the contract is being signed. So that current market price I am talking about. Based on that, the premium will be decided. So intrinsic value is 0. Although, will this contract be available to free on you? It means that will the price of the contract be 0? No. The price of the contract won't be 0. I am telling you why. I am telling you why. Will this contract be available for free to you? No. Why no? Because is intrinsic value the only component of option premium? No, there is time value as well, right? Now, PJ is asking, why would anyone sign this contract? Why would anyone sign such a contract? I'll tell you why. But before jumping to why would anyone sign such the contract, let us get done with put options and then we will evaluate why would anyone enter into such a contract. Okay, PJ? But tell me, would this contract be available? Everyone, please, are you recognizing this fact? Again, the time value of the contract is calculated through delta or theta. The change in prices with respect to time is called theta. And that is something related to geeks. Through an pricing model, it is calculated. It is something related to quantitative finance. That is something we don't want to go to. Okay. But always remember, greater the time left to maturity, greater would be the time value of the contract. Greater the time left to maturity, greater would be the time value of the contract. Everyone clear till this, including PJ, NB, and SG especially? Everyone clear? We are evaluating from a buyer point of view. Put buyer has a right to sell at strike price of 900, where the market price is 700. Something you could have sold at 700, but you are getting a right to sell it at 900. Does this add value to your life? Does this add value to your life, PJ and SG? Does this add value to your life? How come, Soumya? No, if you would have sold it at market, you would have got 700, but here you are getting 900. So 200 rupees profit you are getting through this contract, right? You are getting the profit of 200 through this contract. If you would have sold it at market, you would have to sell it for 700, but now you are selling it for 900. So 200 rupees is the profit. Since it is adding to your life, it has an intrinsic value. Now, just making one final remark and then I will take your doubts. Just making one final remark and then I will take your doubts. The option contract which has intrinsic value is called in the money options. The option contract which has intrinsic value is called in the money options. Yes, we will take a break. Let me just conclude with options and we will go on a break. Don't worry. The option contract which has in the money, the option contract which has intrinsic value is called in the money contract. And the option contract does not have intrinsic value is called out of the money contract. If the option contract does not has intrinsic value, it would be out of the money contract. So if intrinsic value is 0, it would be out of the money contract. Now, question asked by PJ is, why would anyone buy or enter into such a contract? Why would anyone enter into such a contract? On the other hand, that is less than 0. Not, this is not 0, but less than 0. Intrinsic value is less than 0. Then it is out of the money contract. KV, you got what is intrinsic value? Yes, at the money has no intrinsic value. That is correct. If intrinsic value is less than 0, then it is out of the money contract. If strike price is equals to current market price, in case of, in any case, if in case of both call and put options, if strike price equals to current market price, then it will be called at the money contract. If strike price is equal to current market price, both in call options and put options, it would be at the money contract. There are different formulas for call and put to describe moneyness, but I didn't want to bombard you with those formulas, otherwise you would have unnecessarily been confused. This is way simpler method to understand. If intrinsic value is less than 0, it means that over here you had current market price was 700 and right to buy was 900. So current market price minus right to buy, it is minus 200. It is in negative. Intrinsic value is minus 200. That is negative, which makes this out of the money contract. So basically what I am trying to say is, yes, intrinsic value can also be in negative. So if intrinsic value, you got KV, what is intrinsic value? If intrinsic value is less than 0, it's OTM. If intrinsic value is equals to 0, it is ATM at the money. If intrinsic value is greater than 0, that is positive intrinsic value, then it is ITM. Always remember, ATM is very simple. Recognizing a ATM contract is very simple. Strike price is equals to current market price, it would be ATM. Evaluate for ITM, that is whether it has intrinsic value or not. And if it is not ATM and ITM, it is OTM. Okay. Okay, guys, everyone clear? Everyone in the money, at the money, out of the money. If it has positive intrinsic value, it will be in the money. If it has negative intrinsic value, it would be out of the money. And if intrinsic value is 0, it would be at current market. Strike price is equals to current market price, that is at the money. I will come with the examples as well, but some of the students are asking for break, otherwise it would get too heavy. So we would take examples of ITM, OTM, and ATM as well. Let's go on a 5 minutes break, but be right back in next 5 minutes, guys. But be right back in next 5 minutes. We need to conclude derivatives today. We need to conclude derivatives today itself. Okay. By day after tomorrow, SG. By Tuesday, you will receive the recordings. Or probably by tomorrow itself. Latest by day after tomorrow. Sure, sure. I'll take example. Don't worry. Go on a break. Have some water. Freshen yourself up, and I'll be continuing with example. So TB, either you need to have uh, a good years of experience, like 8 to 10 years of experience in core IB, or else you will have to complete IB MBA from a top B school. These are the two ways through which you can reach out to your desired profile. How many round of interview happen? The mock interview has, I guess, 3 chances. You get 3 chances to clear the mock interview, although I'm not sure about it. So in 3 chances, you are expected to clear the mock interviews. For actual interviews, it is something that placement team deals with. So for that, you will have to contact to them or raise a ticket about it. Financial modeling and along with that equity research valuation, these are the skills that you are expected to have. But along with skills, there are few things that you need to have a proven academic track record as well as a good years of experience. It will it will fall, I guess, although I'm not the one who tracks volatility index as such. I'm not a big fan of bits. But although I think after the announcement results are announced, 1 week or 2 weeks after that, it would be in a normal zone. Yes, SG, definitely. If you will work hard, if you will uh, acquire the skills throughout the time of the curriculum, you will definitely be able to uh, gain the skill sets and prove yourself in case of interview. To be very honest, placements are something that a completely different team is associated with. So they will help you out in case of placements. Please raise a ticket about that. If you have any queries, you can ask them. They are definitely going to help you out. Okay. My responsibilities over here are related to training and content development. So if any doubts regarding knowledge base or subject matters, you can definitely reach out to me through the ticket. Okay, SG. So, KM, I won't suggest you to go for any of the paid versions, all the paid versions, even online or offline. I have experienced and talked to my peers, is not worth it. I would suggest you to go with IFT videos. Yes, yes, definitely. There are many people from technical background who have aced the career in finance as well. So don't worry about it. So for CFA level one, there are free playlists for IFT videos on YouTube. You can refer those playlists. That would be sufficient enough. And make sure you solve candidate resource questions. Yes, SG, there are many people from technical background, from engineering background. They have cracked in finance. You would be able to crack it as well. Just make sure you are in touch with the subject. For internships, and basically placement starts when you are in the 6th month of the program. At that time, your placements will be starting. I am technically, if you ask me, I want to go to something like a private equity or something. But TB, very honestly, I'm right now preparing for my exams, my CFP and CFA exams. So for that, I have taken a break from corporate life, but I will resume it soon. I'm planning to resume it soon once I am done with my exams. So for career in economics, AR, if you want to go, thank you, PJ. So if you want to go to make a career in economics, go for equity research profile. There you will be able to evaluate the top-down, the companies with top-down approach and bottoms-up approach. And economic analysis would be the part of your job. Although if you want to make career in core economics, you can go for masters or PhD in economics. Uh, so that would through that you can also publish your research papers that you wish based on economics. So that could be an issue. Senior grade and pursuing. Sir, I'm engineer grade and trading right now. With this course, which profile would be best? So go for financial analyst or trading is somewhat different from what our curriculum covers. We are more into fundamental analysis and trading is related to technical analysis. So although the if you ask about the curriculum, it more suits for research analyst or financial analyst kind of job roles. Don't worry, SG. I have always seen that you are always worried about this. Don't worry. If you will work hard and if you will get, uh, uh, if you are in touch with the subjects, definitely you will be able to deliver. Pressure last year I have done with my graduation now. So these are the all these skills. If you are from a commerce background, was also included in your curriculum. But was these things you knew? Most probably no. So the having studied something for the sake of exams is one thing, and developing a skill knowledge base to deliver to the panel is some other thing. That is what this course gives you. Okay, yeah. CFA basically covers the is the golden standard for finance. It is considered to be one of the best courses in finance, and finance is something that interests me. I find learning finance to be very interesting. I love finance, so that is why doing CFA helps me to get equipped with knowledge. This is how it helps me. So KK, that is something that will come from regular practices. Try to be open up with people around you. Try to try to participate in extracurricular activities during your college days, and try to reach out to new people to have connections with them. That would help you to limit your stage fear and communication issues. Depends on the job profile, KG, that which job are you applying for. So based on that, whatever the job description says, make sure you have those skills and have that knowledge that you can be tested on. For that, though the person who has connected from him, you will have to raise a ticket. There are, I don't know, to be very honest, what are the applications from their end. So you can connect to the team VT Vaishnavi and you can get known about it. No, no, you are not the only engineer. There are many engineers in the here as well. So don't worry about it, Shiva. So IFT is the major video that you can rely on. Don't go for paid sources. That is what I would suggest. I'm doing accounts job. Possible to move in profile related to stock market like equity or commodity research analyst. Yes, why not escape? Once you are equipped with the right skill set, definitely you can switch the career. Even I don't know Tableau GV, so sorry, but I won't be able to help you on. So we didn't thought anything. We were on a break. WS. Yes, KG, about placements and all that, you can raise a ticket and the people who are more experienced than me in placements will help you out. Yes, it is the need of the hour. There were many doubts that was popped up, and I guess I have answered every doubt. So let's get back to our class. Let's continue with our class. I will share a sheet by midweek by Wednesday. In that you will have those questions M. So you can practice it from there. Okay. Let's evaluate from a call option point of view first. When does a call option will have intrinsic value? Option A, current market price greater than strike price. Option B, strike price greater than current market price. Option A. So the formula for intrinsic value is current market price minus strike price in case of call options. In case of call options, the formula for intrinsic value is current market price minus strike price. In case of put options, formula for intrinsic value is strike price minus current market price. In case of put options, formula for intrinsic value is strike price minus current market price. Formula for intrinsic value in case of call option is current market price minus strike price. Formula for put option in case of intrinsic value is strike price minus current market price. Now, if you remember these two things, there is nothing in the world which can make you wrong while judging the moneyness of the options. Now, what is moneyness? Moneyness of the option is derived into three parts. In the money call option, in the money option, at the money option, and out of the money option. Now, why is moneyness essential? Moneyness of an option is essential to evaluate to know whether the option has intrinsic value positive, negative, or zero. Whether the option contract has an intrinsic value of positive, negative of zero or zero. Based on that, moneyness of the option to evaluate whether the intrinsic value is positive, negative of zero. To evaluate that, moneyness of the option is used. Now, what are the three types of moneyness? Tell me. Everyone tell me. First one. In the money. Very good. Second, at the money. Third, out of the money. In the money, positive intrinsic value. At the money, intrinsic value is zero. Out of the money, negative intrinsic value. Clear? Clear? Let me give you some questions so that you can be more clear with it. These are example of call options. You need to give me whether the option is ITM, OTM, or ATM. First, strike price 900, current market price 1200. Tell me. Strike price 900, current market price 1200. This is ITM. Anyone doubt? Anyone has any doubt why this is ITM? Anyone? Please ask me to stop here itself if any one of you. Yes, in case if this would have been a put option, it would have been OTM. Yes, GB, you are correct. Anyone has any doubt? Second, strike price is equals to 900 and that is the same spot price. What is this? ATM. Very good. At the money. And finally, third one, strike price 1000, current market price 700. OTM, what is the intrinsic value in this case? Minus 300. Minus 300. 0 is in this case. Because why? Why minus 300? What was the formula? Current market price minus strike price. This was the formula for intrinsic value. Current market price minus strike price, remember? So current market price 700 minus 1000 gives me minus 300. Everyone clear with this? Shall I go on to the next part? Yes, I will show that as well. Don't worry. I'll show that. But right now market is not open. So it would be somewhat difficult to get to explain you how live it is working. Entrance ITM can't be negative. What do you mean by ITM can't be negative? In the money, yeah, in the money options has intrinsic value positive. Yeah, in ITM options, that is in the money options, have intrinsic value positive. Black and Scholes model are option pricing model that is used to find the premium of the options. We are calculating intrinsic value part, right? We also have a time value component. So using geeks, that is theta, vega, gamma, delta, all those things are used to calculate come at intrinsic value. Intrinsic value can't be negative in OTM as well. In OTM, intrinsic value will always be negative. In OTM, intrinsic value will always will negative. In ITM, intrinsic value can't be negative. In OTM, in case of OTM, here itself the intrinsic value is negative, right? Are you seeing this, Priyanka? The intrinsic value is negative over here itself. So why would anyone say that intrinsic value can't be negative? Okay. ATM is strike price. If strike price is equals to current market price, here I gave an example that it to make you understand the moneyness option. Here I gave you example. It does not add any value to it. So it does not has any value. While calculating premium, to make you understand that what is ITM and OTM, I cannot just directly bombard you with formulas, right? I cannot just directly bombard you with these formulas, otherwise you will get confused. So to make you understand what is actually moneyness, if that is adding intrinsic value to your life, then it is ITM. If it is not adding, then it is OTM. Now, later I introduce the concept of negative intrinsic value so that you may not get confused. It is also essential for me, along with making you understand the concept, keep it simple and easy so that every one of us understand it, right? Because I know, Priyanka, you might have remembered something from your college days about options, but there are people who are from non-commerce background, and it is essential for them to break it down into smaller pieces. Sometimes I know it may feel, for those who already know few things, it may feel, guys, like I am going very much slow. I am discussing very basic stuffs, but please try to understand that your peers are also learning with you, right? So we need to take care of everyone. So yes, OTM options have negative intrinsic value always. ITM have always positive intrinsic value, and at the money options have intrinsic value 0. Now, same for put options. Current market price 900, strike price 1200. ITM, OTM or ATM. Current market price is equals to strike price is equals to 1000. And third one, current market price 1000, strike price 800. Tell me whether this is ITM, ATM or OTM. First one. First one. See over here, what is the formula for put options? Strike price minus current market price. If strike price is greater than current market price, then it is an ITM. Let's see. Strike price is greater than current market price. It is an ITM. Current market price, this is always be an ATM, no matter whether it is a call option or a put option. And over here, it is OTM, because something is worth 1000 and someone is asking you to sell it at 800. It has negative intrinsic value. So with this, we are done with options. Finally, we will be coming to swaps. Finally, we will be coming to swaps. Now, what is swap? What is swap? Have you heard this word for the first time? What is swap? Okay. How many of you have heard this word for the first time? Yes, M, you are correct. Okay. Swap is nothing but exchange. Yes, yes, I'll come to. Okay. Just give me a second. Okay, guys. So one of your peer is asking me to show the example of Nifty and make you understand what is ITM, OTM, and ATM. So let me share my screen and I will show you the option chain. Let me just share my screen and I'll show you the option chain. With by completing that, I will go to swap later on. Okay. Once I am done with that, it would hardly take 2 minutes, but since she is curious, let us just see that. Okay. Nifty option chain. This is Nifty option chain. You can see some part of this is in shaded area and some part of this is in shaded area. The options to my left of the screen are call options. The option to the right of the screen are put options. Okay. The option to the left of the screen are call options. Option to the right of the screen are put options. Let me open this in. Okay. This website is better than opening that in Excel. Yes, but that is not safe to say, because when the market is in consolidation, it means that market does not so much volatility, then both call premium and put premium would fall. So it is not safe to say that call options always behave opposite to put options. If market, as I said, options seller volatility. So if the market is flat, both seller of call option and put option will gain because of time value of money. So that is again, you are coming from the trading part, but okay, that's fine. So here, current price of Nifty is 22,530. The current points at which Nifty has closed, that is last closing price of Nifty is 22,530 for Friday session. I think tomorrow Nifty will shoot up. Let's see what happens. I think that tomorrow Nifty may shoot up. So if Nifty shoot up, who benefits? Call buyer benefits. So Nifty is 22,530. So this is 22,550. 22,550. And above this, let's evaluate the left side first. 22,550, 22,500, 22,450, 22,400, and this is 22,530. So this, all these options that are in shaded area are OTM options. OTM options, out of the money options. So 22,550 is the strike price, and 22,530, 22,530, 22,500, 22,450, it is less than the current market price. 22,530 is the current market price, and all the options less than 2530 in the call side are OTM options, out of the money options. Okay. Let's see, just a second. 22, 500, 450, 400, 350. 22, 530 and 20. Okay, okay, okay. No, this is OTM, right? SK. 22, 500. In the money call options. Yes, in the money, in case of call options would be. What happened? Just give me a second. Let's check. In the money for call option would be when current market price is greater than the strike price. Current market price is greater than the strike price. In all these cases, current market price will be greater than the strike price. That would be yes, correct. So guys, yes, you are correct. I agree. So what is ITM options? Let's get back to our scribbling part and then we will discover it again. I'm sorry, my bad. So let's evaluate call options. In call options, if I want ITM options, that is in the money options, what you will need? A current market price greater than strike price, or current market price less than strike price. What would you want? Current market price greater than strike price, right? Current market price greater than strike price. And what is the current market price? What is the current market price of Nifty? 21,530. So everything below 21,530, everything below 21,530 will be the ITM options. Everything below 21,530 would be the ITM options. Are you getting this? So everything below 21,530 will be the ITM options. Actually, I was looking with put and telling about call. So that is why the confusion was all about. So everything below 22,530 would be ITM options. So this shaded portion is in the money call options. This shaded portion is in the money call option. Now, yes, Vaishnavi, ask me what is your doubt. Vaishnavi, please ask me what is your doubt. Now coming to put. Coming to put option, if I want to find ITM options, what I would want? what I would want, current market price less than strike price. Now current market price is 22,530. So everything greater than 22,530, everything greater than 22,530 would be my ITM options in the money options. So everything greater than 22,530, that is 22,600. 22,600, 22,650, 700, 750, greater than 22,530 would be my ITM options in put case, in case of put options. So this is my put options and the shaded portion is ITM options. Now the shade is ending over here 22,550 and the shade for shade for call options is ending over here and shade of put options are starting over here. So this 22,550 and 600, basically 22,550 and 600, these two would be the closest options, that would be ATM options at the money options. If it's less than 22,550, NSE screen is not reflecting. Guys, is NSE, are you not able to see my NSE screen? Okay, now, is it perfect? Now, all these options that are higher than, in call side, I am talking about the call side, all these options that has a strike price greater than current market price. If strike price is greater than current market price, strike price is greater than current market price, it is an OTM options. Yes, if the strike price is greater than current market price, it is an OTM options. On the other hand, in case of put, if the strike price is less than current market price, it is the OTM options. So this is basically, although it seems to be confusing, this is in tabular format. This is something that we open very less. Again, I said I am not very much associated with trading part and open interest, last traded price. All these things are something that the one who is closely associated with trading looks into. So 22,530 is the current market price. Strike price is given over here. Can you see this strike? This strike price is given over here. This is strike price. Okay. So basically shaded portion is ITM and non-shaded portion is OTM. Thank you, SK, for correcting me again. Let's move on to the swap. Swap is a very little part of the curriculum. So swap is nothing but exchange. Swap is nothing but exchange. So let's say I am A and I am B and you are B. I can't be A and B both, right? So let's say 22,550 is also shaded because it is the closest. There is no option for 22,530, right? Shivani, there is no option contract for 22,530. There can't be option contract for 22,550, 51, 52, 53. Similarly, 30, 31, 32, 33. So in Nifty, option contract are made at 50 points interval. So 22,550, 600, 650, 700. That is why 22,550 was also shaded. Yes, in Bank Nifty, it is 100. Correct. So swap is nothing but exchange. So let's say I am wheat producer and he is rice producer. So I will give him wheat and I will take rice from him. So that is a swap. That is just an exchange. Similarly, there is something called as fixed interest rate and floating interest rate. This part we are going to cover in next class where we'll be starting with fixed income. So what will be in swap? A and B are the two parties. A will give him fixed component and B will give a floating component of the interest rate, floating type of interest rate. So this is fixed interest rate and floating interest rate. So on what assets swap can be signed? Swap contracts can be signed on commodities, equity, index, currency, and even interest rates. Swap contracts can be signed on commodities, gold, silver, copper, iron, equity, Reliance, Tata Motors, HDFC, or other such security index, Nifty or Bank Nifty. I can pay you the points that Nifty gives. You can pay me the returns on Bank Nifty. I will pay you the bank's returns on Fin Nifty. You will give me the. These are done on exchange. Swaps are OTC derivatives, over the counter derivatives. Currency, I can exchange rupees. Forex market is one that deals with this. I can exchange rupees for dollars, right? That is currency. Interest rate, fixed interest rate, floating interest rate. This we are going to see. We are going to see more in swap contracts in fixed income. OTC is over the counter derivative. This we covered in the first class. If you remember, exchange traded and over the counter. So in next class, we will be starting with fixed income, and there we will be seeing how is swap contract signed on interest rate. And in next class, we are also going to see securitization. That is one of the very interesting topics that you guys are going to enjoy. So that was it for the day, guys. I hope you enjoyed today's session as well. If there is any feedback for me, please let me know so that I can improve myself and help you out in future as well. Okay, American options and European options. Yeah, we missed that part. Okay, no worries. That is a very small part about when the options can be exercised. That is something that we can discuss in the next class before starting with derivatives. It would take hardly a couple of minutes. Earlier, there was barter systems. Swap can also be settled in cash, right? Swap can be settled in cash. And barter system, you were exchanging commodities for commodities. So that was the difference. Although there are similarities, but yeah. Yes, yes, the scribbled part will also be uploaded on the PDF. Um, so if you have any review for me, please let me know. Thanks, Diego. So that I can improve myself for you. Thanks a lot. Sure, I'm sharing the notes. The notes are being uploaded. The PDFs will be sent to you. Don't worry. The PDFs of the whole chapter will be sent to you. Although I'm not targeting anything yet, that is the ultimate goal for 5 years down the line. Let's see what happens. So it's not about the package, it's about the work that we will be doing. We should love that. For basic of economics, everything is already uploaded. If you have not got it, don't worry. It would be uploaded soon. So yeah, for every module is covered, like today derivatives are covered. You will be provided with notes for derivatives. There you can see everything that would be given in notes. Will have been covered in class. For example, everything covered. If basics of economics notes is provided to you in PDF, go through that basics of economics note. And if you are not understanding anything, you can come to the live class. Every aspect of the PDF has been covered in live class as well. So once you will be getting the derivative notes, sir, in most of your example. So exchange is what it is doing. It is buying from one and selling to other, right? And based on that, they are charging some fees. So the fees component, because unnecessarily it will all already this is a very confusing subject, right? TG. So to understand the characteristics, it is important to avoid the complexities. So that is why uh, we have not included exchanges while narrating the transactions. Notes are in English. AP says that she has received notes. Everyone of you might have received notes. If you have not received notes, you can go through the uh, portal and raise a ticket about it that you have not received economics notes. Don't raise a ticket for derivative notes. Derivative notes will be uploaded by day after tomorrow, that is Tuesday. For economics, if you have not received it, you can raise a ticket about it. You can go through that. Each and every topic might have been, I am pretty much sure is already completed in the live class. It is in LMS. Notes are provided on LMS under notes section or the specific subject section. Yes, raise the ticket to ask a doubt. If you're not able to find the economics notes, derivative notes will be uploaded by Tuesday or Wednesday. Okay, bye-bye. Take care. Have fun. No, RT, the timings are fixed. Although if there is something that you would like to request, you can raise a ticket about it. Bye-bye, guys. Take care. Have fun. Bye-bye. Thank you.